IRS Form 433B. This is the collection information statement for businesses. So if you're a business that is submitting an offer in compromise to the IRS for consideration, you're going to complete IRS Form 656. That's the offer in compromise. And then the IRS requires taxpayers to submit a collection information statement. So basically, that is a list of your pertinent business information, all the relevant people that are involved, and then a list of assets, liabilities, income, so on and so forth. Basically, like a snapshot of your current records. From there, the IRS you'll go through a series of calculations to come up with what's known as an offer amount. And we'll go through that in a little bit more detail. From that, the IRS will decide to either accept or reject your offer in compromise. Usually, the IRS will reserve the right to examine pertinent documents, ask for additional documentation, and all of this is to make sure that the information you're presenting is accurate and true and correct to the best of your ability. So what we're going to do is just kind of walk through briefly each of the sections, and then we'll go back and complete this form as intended. So let's go through each section. Section 1, we'll talk about the business information. This is for both a domestic or a foreign business. Section 2 is going to be about business assets. So this is going to be where we spend most of our time. Section 3 is about business income. Section 4 is going to be about business expenses. And then Section 5 is going to be where you calculate your minimum offer amount. This will be the information that you then put on your Form 656, the offer in compromise. Section 6 contains other information that the IRS will want to know to take into consideration. And Section 7 is the signature section. And then there's a list of attachments that you should make sure you include as part of your submission. So let's go back to the top of this real quick. And before we get started with Section 1, we're going to go over some of the information just to make sure that we're completing the correct form. So Form 433B is the business collection information statement, and you should only complete this form if your business is officially a business according to the IRS. So that would be a corporation, a partnership, an LLC that's classified as a corporation, or an other LLC. Unfortunately, the IRS really doesn't have a clear definition of what other LLC is. However, if you're operating as a sole proprietor, if your LLC is a disregarded entity in the eyes of the IRS, which means basically a one-person LLC, then you're probably not going to be using this form. And instead, you would use the Form 433A, which is the collection information statement for wage earners and self-employed individuals. So that's the form that would be submitted with the offer in compromise, not 433B. So now in Section 1, we're just going to go ahead and assume that this is for for a business that's multi-ownership. So let's just start completing the field. So John Doe, he is completing the information on behalf of his company, Acme Corporation. So we'll just go ahead and complete Section 1. So the top part is information about the business. As we get down here, we're going to get into information about any partners, LLCs, major stakeholders. So the big caveat is if there's a place that you're completing information and you need additional space, you can include attachments. The general rule is the IRS isn't going to give you a template for any attachments, but the attachments should contain the same information that they're asking for here. So you won't need an attachment for here, but for example, if you got to the point where there were more than 1, 2, 3 involved people that still were major shareholders, then you could probably attach a document that has their name, title, ownership of percentage in their annual salary, social security number, address, so on and so forth. So as long as it has the requisite information, you can attach as much documentation as possible. So if there's a DBA or a trade name that's separate, you would put that in here. Right now I can't think of one on the fly, so I'm going to leave that blank. If there was a secondary phone, you'd put it here. Business mailing address, you would indicate if it's different from above. Let's just say that they receive their mail at their physical address, but if this was a post office box, if they received their mail at a different location, then you would put that information there. You check whether or not this business is a federal contractor. You can check here if you're the only employee. Let's just say that this is a company with 10 employees and they do outsource their payroll to Acme Payroll Corporation, and they're down the street. And so frequency of tax deposits, let's just say that they're a semi-weekly tax depositor and their average monthly gross payroll is $500,000. So now we would enter all the information. So let's say Doe. John Doe is the president and he owns 60%, and his annual salary is $120,000. Yep, his social security number is easy to remember because it's the same as the employer identification number, which we all know would not really be the case. And then let's just say his partner is Fred Smith. He owns the other 40%, and let's just say that his salary is $100,000. And then we can kind of understand COO. The rest of these fields are pretty self-explanatory, so I won't go through the belaboring detail, but there's room for a third person if you needed to. And then, as mentioned, you can just attach documentation as necessary. In section 2, we're going to gather the current statement from your bank, lenders, mortgages, any monthly payments, loan balances, depreciation schedules. You're going to want to have records of your vehicles, current values of your business assets. There's guidance on how you can consult resources like Kelley Blue Book, real estate postings, to come up with accurate statements. So, a common question that I've received is, how do I make this work so that, to my favor? Well, I'm not going to give advice on how to do that. My advice would be to make sure that the information you're presenting to the IRS is true and correct to the best of your ability. There's actually a penalty of perjury statement that you'll be signing as part of this, attesting to that fact. So true, correct, and complete. So under that guidance, basically the calculation is kind of informed by how much available assets you have. So the more assets you're representing to the IRS, the larger your offer amount is. And, if you have fewer assets that are reportable, then your offer amount could be lower. Just keep in mind, first, you can't misrepresent any facts. Second, the IRS does reserve the right to go back and review accounts. So if you're trying to play games or, maybe take the best available statements, the IRS is going to probably notice inconsistencies and make sure that you provide documentation so they're comparing apples to apples. But in your best interest, it would serve you to make sure that you don't misrepresent things by selling yourself short. So you can take, for example, when we get down to, say, business assets, real estate, there is a loan balance. You want to make sure that that figure is accurate and represented fairly. You do want to make sure that you do the calculation to that the IRS authorizes you to knock 20% off of the estimated current value of your property, because again, the interest here is to make sure that you're representing things fairly and accurately. But when it comes to, say, a piece of real estate, the market value of that real estate, the true market value, is only defined once you put it up for sale and someone decides to buy it from you. That's the true market value at that time. Everything else is an estimate. So you can find a trusted real estate agent that would present a market value. You could probably find 5 that would give you 5 different market values, and you could, see how that works in your favor. But when doing this, you should keep in mind that the IRS has the right to come back and challenge your assertions. So when you're picking and choosing how aggressive you're going to be, keep that in mind. So, and the best guidance would be to be consistent. So if you're going to fairly represent the liability side of things, you should fairly represent the asset side of things. It's only natural for the IRS to make sure that you're being consistent. So enough of the preach. Let's just say that John Doe has some cash in a safe. They also have a checking account that they work at. So cash, basically, you can just put, you're not keeping cash in a bank, but let's just say that they have $10,000 of cash in a vault, and then they have, an account at Acme Savings and Loan, and it's a checking account, and their account number is 1. And let's just say that they have $50,000 of working capital there. Maybe they have another account, like a savings account, and that account is 2. And then they have let's just say they have another $50,000 here. So the total bank accounts from attachments. So if you have more than 2 bank accounts, you would provide an attachment that has all of this information. And let's just say that there's nothing there. So this would be $110,000. All right. This part, line 2, basically is investments. So from here on out for the rest of section 2, I'm going to fill in 1 line per category. So let's just say that we have stocks, and we have at Acme Investments. Let's say that this account is 3. The current market value of these stocks is $50,000. Let's just say that these stocks were bought on margin. So there's a $20,000 margin on that. So really we have $30,000 of equity in there. You can do the same thing if you had like a different investment account that had bonds or whatever. This 2C would be for digital assets. So if you had a cryptocurrency wallet, if you had, Bitcoin somewhere on an exchange account, then you would enter that information here. We'll just say, for the sake of argument, that John Doe, he plays it old school. He doesn't have any of this. He doesn't have any other outside accounts, so his total net investment is $30,000. This section right here doesn't go into the calculation because these are receivables, basically meaning that the IRS could ask for more detail, or at least this gives the IRS indication that you should be expecting some income at some point. And so you're going to not use any of the figures here because you can't collect against receivables, but the IRS does reserve the right to collect against future income as it comes in. So there's a difference between notes receivable and accounts receivable. So notes receivable would be like something backed up by an official loan agreement. So an outstanding loan that says I'll pay you X amount of money over X period of time, X percent, interest rate, so on and so forth. Accounts receivable is really kind of like a credit, like a store credit, like you maybe you did work for a company and they paid you 25% down before you started the work. You completed the work, you've presented an invoice, they've got 60 days to pay the invoice. That would be an account receivable. So it's not backed up by an official note because you expect that the receivable will be paid within that 60-day period. So if you have notes that's receivable, you would attach a current listing that says, here's the names of whoever owes me money, how old the note is, and then how much is on the note. So John Smith, we've been holding a note for him for the past year. There's $10,000 left on the note. Accounts receivable would be Smith Incorporated, has had an account balance with us for 3 months, and they owe us $30,000. So let's just say that they don't have any of those. If they did, the only additional action would be to attach a listing of the pertinent receivables. Here we're going to attach real estate. Let's just say that there is nothing currently for sale, but if we wanted to sell the building on 1000 Main Street, let's just say that it's an office building. We bought it back in 2020. Monthly mortgage payment, let's just say it's $5,000 a month. Date of final payment would be, I don't know, let's say that we've got a 20-year mortgage, so let's call that 2040. Oops. And this is being held by Acme Savings and Loan. And let's just say that this is a $500,000 property. We multiply that by 0.8. We've got $400,000 current market value. We've got a loan balance of $300,000, which means the total asset value of this real estate is $100,000. That's what the IRS would expect to reasonably, get if they seized the property and the turnaround had sold it and paid off the note. Of course, this doesn't factor in closing costs or anything like that. So if you have a second property, you can list it here. If you have an attachment, you would put it there in 3C. So we'll just put $100,000 in line 3. So right now we've got $110,000 in cash and equivalents. We got $30,000 of investments, and then we've got $100,000 in real estate equity. So in this section, we're going to put in business vehicles. Let's just say your make and model. Let's say he's got a work truck, a Ford F-150. That's from 2023. He bought it in 2024. It's got 20,000 miles. And they own it. Still making payments. Date of final payment, let's just say that that's 5-year loan. Current value of this truck, let's just say that it's $50,000. After knocking that 0.8 down. And again, if you want to make sure that you're submitting the lowest possible offer, don't forget this calculation. If you forget this calculation, it will result in a balance that, or in a higher offer amount than you could be entitled to. So let's just say that there's a loan balance of $20,000, which means there's $20,000 of car equity here. Now, if this is a lease, you would just stop right here. You would probably still have to put in your final payments, but you wouldn't need to put in this market value. It's just zero, because you walk away from a lease, the government can't get any equity out of it. So you can do this for 2-3 more vehicles. If you needed to attach, additional documentation, you can always do that. So we're just going to go to $20,000 right here. And then if you have other equipment, you would put in the type of equipment, do the same calculation. Let's just say that we're going to skip this because there's no real value here and they don't really have a lot of equipment. But you would put in a list of equipment, and then you would take the current market value minus any loans, and you would attach the value of all the equipment there. So now we're going to add lines 1 through 5. So as you can see, each of these lines, 5A, 5B, they all roll up to line 5. So we're going to go back to, and this is the way it is for all of these, we're going to go back to line 1, just make sure that we cover the bases. We've got $110,000. We've got $30,000, so that's $140. This makes it $240, and then this is $260. And then we don't have anything here, so we have $260,000. So this is going to be used further down. I'll go ahead and give away part of the ending here. So we're going to take right here, and we're going to just pre-fill that. So now if you're using tax software, this automatically populates. So now we're going to go into business income information, business expense information. You're going to want to enter the average monthly gross monthly income of your business. And in order to do that, you would use the most recent 6 to 12 months of documentation of your commissions, invoices, gross receipts, blah, blah, blah. So you do have some discretion on whether or not 6 months worth of earning statements or 12 months worth of earning statements reflects the most accurate information in your situation. This is going to depend on things like the seasonality of your business. Obviously, if you were operating a pumpkin patch, if you put in January through June's income, it's probably going to lowball this. If you put in anything that included the month of October, that would probably overrepresent this. A fair average would probably be 12 months of earnings. Now, the IRS always does reserve the right to ask for additional documentation. So if you do something shifty like take your most favorable business information here and then pick and choose different dates and statements for your most favorable outcome in the expense section, the IRS is probably going to notice that as an inconsistency, and they're probably going to ask you for the required documentation so they can make sure, again, that they're comparing apples to apples. So let's just say that we're going to do 12 months of earnings from 2024, the most recent completed tax year. So now the IRS may say we want something more current because at the time of this recording, we're actually in August of 2025. So they might want to say, hey, give us your July 2024 through June 30th, 2025, P&L, right? So if you're attaching a P&L, you don't have to complete this information. You can just attach the P&L. You can put the total gross monthly income, and remember, this is a monthly figure, so you're going to have to go back and do the math on this. if your P&L for a year says $120,000, you do need to divide that by 12. Make sure that you're representing $10,000 a monthly business income, right? You don't want to put $120,000 in here because the IRS will say, you can give us more money than we thought, so we'll go ahead and take as much money as we need to. But if you need to put in information, you can always do that. Again, the IRS does reserve the right to ask for documentation to show gross receipts, rental income, interest and dividends, and other income as you would specify. So we'll skip that. We'll just say you can either attach a P&L that shows your average monthly income to be $10,000, or you're going to need to tally this up and provide documentation as an attachment. And then same here. This would look kind of suspicious if you cherry picked different dates. So like if you just said, oh, well, we're going to do 1/1/2025, then the IRS's logical question would be, why did you pick different dates? So if you're going to do that, do that based on advice from your accountant or counsel. But I definitely would make sure that I have a ready explanation for that. And again, if you have a P&L, you don't have to complete lines 11 through 20. You can simply attach that P&L and then enter the total monthly expenses here. So let's just say that that's $5,000. Now, this is box B and box D. Neither box D nor box box B or box C are in there because there's a figure known as box D, and that's going to be the difference between box B and box C. So $10,000 minus $5,000, we get $5,000. That's going to be the figure that we carry down here to the calculate your minimum offer amount. So we'll go ahead and put $5,000 in both of these fields, and we're going to go over these items. So when calculating your minimum offer amount, the IRS is going to want you to take your available assets, and then they're also going to want to calculate the future estimated income that you have. So if your offer is able to, if you're able to pay off your offer in compromise in 5 or fewer payments over a time frame that's 5 months or less, then you get to use this top one, which is a smaller amount. If you're going to pay your offer over a 6 month to 2 year time frame, then you would need to use this bottom one, which is going to be a different number. And it's literally twice as much. So you take your discretionary income, the $10,000 minus $5,000, which equals $5,000. We take this, multiply it by 12, we get $60,000. We do this here, and we get $120,000. So we've already got the amount of assets in box A, and you're going to take either the box E amount or the box F amount and put that in here. And then you add these two up. And that's going to be what you place into section 4 under your payment terms for your offer in compromise. So now you can exclude equity in income producing assets except for real estate shown in section 2. So if you did have assets that were producing income, then you would be able to pull that equity out from here. So most likely that would be your business assets right here. So other business equipment. If this was a piece of equipment and you're able to say, you know what, I'm going to set that aside because it's, technically income producing property that's not rental real estate, you could do that. In section 6, this is a series of yes no questions, so there's not really additional information from your balance sheet or anything like that. But this is just simply questions that will answer background information that the IRS is curious in terms of where they would stand as a collector. So, is the business currently in bankruptcy? Yes, no, maybe so. Generally speaking, the IRS is not going to accept offers in compromise while you're going through bankruptcy proceedings, mainly because they want the certainty that they're top of the priority list when it comes to collections. So if you're going through bankruptcy, that might not be the case. The IRS will probably likely at least suspend collections until you emerge from bankruptcy and then reserve the right to come back and say, hey, remember those taxes you still owe us? Yeah. So that's how the IRS would generally think about that. Has the business filed bankruptcy in the past 10 years? I'm not going to complete these fields. I'll just walk through them. But let's just say no. If you did, you'd have to complete the date that the bankruptcy was either dismissed or discharged, petition number, and then the court location where it was filed. And again, all of this is so that the IRS can pull up the background information and then make their own determinations. Does this business have other affiliations? Like, is it a subsidiary of another? Is there a subsidiary of this business that reports to it? Are there parent companies? Are there shell corporations? This question doesn't ask about shell corporations, but because it's under penalties of perjury, this is your opportunity to get caught lying. So if you did set up shell corporations to hide assets, and you say no here, and then the IRS does research and finds out otherwise, well, now you've got additional problems to worry about. Do any related parties owe money to the business? Well, the IRS would like to know because they're going to try and get a cut of that income or that money as it comes in. Is the business currently or in the past party to litigation? If yes, then you would need to complete information related to it. So, was it the plaintiff or a defendant? Where was the lawsuit filed? What was the subject? And again, this would be good background information for the IRS to understand if you're still paying out for a lawsuit that's already been recorded. That would be a different situation than if you have a clean history of taxes. Have you ever been party to litigation involving the IRS or the United States government? If yes, and the litigation included tax debt, then you would provide the types of tax and periods involved. Again, the IRS has this information, so this is an opportunity to trip up and expose yourself to additional penalties. So don't, I won't say don't take the bait, but don't try to beat around the bush on things that the IRS can easily verify or disprove. In the past 10 years, has the business transferred any asset with a fair market value of over $10,000 for less than full value? Well, if it's less than full value, that means you gave it or partially gifted it to someone. They're going to want to know. This would also be kind of the shell corporation thing. Maybe you took a bunch of assets and you dumped them into a shell corporation, and since you transferred them for less than full value, the IRS expects you to report that. Same thing in the past 3 years. Have you transferred any real property? If so, list the type of property, the value, and the date of the transfer. Has the business been located outside the United States for 6 months or longer in the past 10 years? Do you own any assets or real property outside the United States? Do you have funds being held in trust by a third party? And do you have any lines of credit? Again, all of these are things that the IRS would want to know about so that they have a full accounting of your assets and have a better understanding of whether or not you're trying to play a shell game or whether or not you're being earnest with your offer and compromise. And then signatures, so only one person needs to sign. That person should be a representative of the company, so indicated by their title and then the date. And then at the bottom here, you've got a good checklist of all the attachments that you'll need to provide. A P&L statement, the 6 most recent bank statements for each business account, copies of the 3 most recent statements for each investment account. If assets were used as a collateral for loan, then you would need copies of loan statements, outstanding accounts and notes receivable, digital asset records, mortgage statements, supporting documentation for special circumstances as outlined in Section 3 of the Form 656. A power of attorney form if you want your CPA or attorney or an enrolled agent to represent you, and then the signed and current offer and compromise. And then you'll follow the guidance on the offer and compromise instructions on how and where to file it. Oops, sorry about that. Fortunately, we're pretty much done, so that just scrolls me back to the top. Unfortunately, it deleted all the information that I put in here. So that's all we have. Again, this is a collection information statement for businesses. This is the business submitting an offer and compromise. You may find yourself in a position where you're having to do this for a business and on the personal end. Those would be 2 separate transactions that you would need to submit to the IRS based on your situation. However, if it is a single business owner or a sole proprietorship, you would put all of that information on one form, the 433A. So that's all we have for this video. I think we covered all the bases here, but if you have any questions, please feel free to pop in a question in the comments, and I'll be happy to get back to you. We'll also put links in the comments in the show notes to the relevant resources we've created about some of the forms that we've mentioned here. So if you like our articles, for example, please subscribe to our newsletter. If you like our YouTube videos, please subscribe to our YouTube channel. And as always, if you have any questions or comments, or if you'd like to see another topic covered in an upcoming video, please hit me up in the comments section. Thank you very much and have a great day.